So finance and investment, guys, I can't go through every single possible way that they could finance something or every single possible investment they could do. So I'm going to do a quick little summary of the different types just to get you thinking. And then we're going to just focus on one just so that you can see from the whole process, initial recognition, subsequent measurement, and disclosure. So in terms of financing, they could obtain a loan. They could issue shares to get capital, or they could potentially take out a lease which has a finance element. In addition to that, the lease also has the investment element in terms of the asset that they would be leasing. So your other types of investments, they could give a loan to someone. They could have PPE, property, plant and equipment, investment property, intangible assets, or maybe they go and purchase shares. So lots of different things to consider here when we're looking at finance and investment. What you also now need to consider, having seen some of these things, is additionally to IFRS, there are other legislations and regulations that are going to handle these. So think about issuing shares, Companies Act, requirements on how to go about issuing shares. And with the issuing of shares, there could be dividends, and once again, the Companies Act requirements for giving dividends. If they give a loan, it's financial assistance, but it might not meet the criteria of Section 44, Section 45 in terms of the Companies Act, unless it is to directors or to a related party, in which case Section 45 is applicable, or it is to future shareholders, so they can buy shares in the company. This hardly looks like shares, guys. Let me redo it. But also in terms of just giving out any kind of financial assistance, even if it isn't to a direct or related party or to future shareholders. So it's not Section 44 or Section 45. What you still need to consider in terms of the Companies Act is liquidity and solvency, and whether potentially there is reckless trading. In making these kind of decisions. And then purchasing shares, who you're purchasing them from, because again, it could be Companies Act requirements if you're purchasing from a subsidiary or a related party. If we think back to the cycles, let's just think of the documents that would be applicable here for each of these. So if there's a loan, there would be a contract for that loan. Issuing of shares, there would be share certificates. There would be share registers. The lease, there would be a lease contract. Giving a loan, there would obviously be a contract. Buying PPE, there would be either an invoice or a contract for that. And the same for investment property. But there could also be here title deeds. Intangible assets, an invoice or contract. And purchasing shares, there would be share certificates. and in the company that they were purchased, there would be share register with that detail. In all of these, there should be an entry that affects the bank. Okay, giving a loan, money's got to go out. Getting a loan, money needs to come in. Issuing shares, money needs to come in. Purchasing shares, money needs to go out. Okay, and your PPEs or your investment properties, even if you do so on credit, eventually there should be that outflow of cash for it. So we should have an entry where in your financing cycle there will be an inflow of cash, and in your investing cycle an outflow of cash, and therefore we should have bank statements showing that. Okay, but we'll look at that now. Other than that, guys, just remember in terms of the cycle, your authorization was always through the minutes of meetings. And that makes sense because think about these requirements here where we've just noted additional Companies Act requirements. There was always going to have to be a decision made either by the shareholders or the directors or both, and those decisions would then be documented in the minutes of meetings. Okay, so if we're looking at the journals, from a finance perspective, you expect to have a debit of bank and a credit of liability or equity. And so you have your date for your journal, your details, and your amount. And then, subsequently to this, you expect that if there's a liability, that there would be an interest accrual over that. And then, again, a payment where you would eventually have to debit your liability and credit bank. So this is for your finance side of things. And for your investment side of things, you would expect to have a debit of the investment, so the asset, and your credit of either a liability or bank. So your IFRS requirements are going to differ depending on what financing option you've selected or what investment you've selected. So as you're going to have to make sure you're looking at those specific IFRS requirements. But ultimately what you will have is an initial recognition in terms of the transaction, which would be the purchase, or let's say the addition in terms of your investment, or the disposal in terms of your investments, or the issue of shares, or the addition to your loan, or the repayment of your loan. Any of those would be the transaction which needs to be recorded initially in order to get the entry into your accounting records, but then there would be your subsequent measurements. And again, in terms of your IFRS requirements, so what is the model that's been chosen to subsequently measure? Have you gone on a cost? Have you gone on a fair value or revaluation model if we're looking at your assets? In terms of your liabilities, what is the interest charge, repayment terms, and so on? And so you'd have to test that subsequent measurement too to make sure that the closing amount is correct for disclosure and presentation in the financials. Okay, the risks here. You have to see the two elements to it, guys. You have to see the transaction side first. When they are initially recording that asset that they've bought or that liability that they've just incurred, it is a transaction. Although it is an asset or liability or equity, it's still a transaction. And therefore, it's going to be the risks that it's recorded on the incorrect date or description. So it's in the incorrect account, or amount. So the initial recording is at the incorrect amount. Or that it shouldn't have been recorded because the risks and rewards haven't actually transferred. Again, this is dealing with all journals that have actually been recorded, but ultimately there's a risk that they don't record a journal. And therefore, it should have been, but they haven't. So it wouldn't actually be in a situation where there is a journal here for you. But then, post that, you've got your year-end balance, which is dealing with what's left at year-end. And this is where all that subsequent measurement needs to be considered, because there's a risk that the value at year-end is incorrect. Or that they've actually gone and sold it, and therefore it doesn't exist. It should have been removed. Or that it does exist, but they have removed it and they shouldn't have. So they haven't recorded it. Or they don't have the rights or the obligation for that asset and or liability, and therefore there's a concern with that closing balance. So guys, like I said, I wanted to make it a little bit more applicable, so I've done one item here and I've said, okay, let's do investment cycle, let's look at PPE. So in terms of your IFRS requirements, you've got to choose cost versus revaluation model. However, it is irrelevant when you're doing your initial recording. So this is the initial addition to your PPE. You've gone and bought a vehicle. So initially it must be recorded at cost, and they have to include import duties cost to bring it into location. So you're going to have to do this additional testing to make sure that the costs that should be included have actually been included. What's going to be the document to help you here? The invoice or the contract. Subsequent measurement now depending on the model they've selected, they will still have depreciation, they will still have to consider impairment, but if they've chosen the revaluation model, there would have to be a revaluation calculation done, and you're going to have to consider the deferred tax consequences because the tax base differs from the carrying amount. Okay, so where are you going to get this depreciation? This is an estimate based on their own accounting policy. So you're going to have to test this accounting policy and this estimate, remembering that fraud risk, significant risk because of the estimate side of things. Impairment now. Impairment is also going to be an estimate. So they're also going to have to consider whether they have actually determined the impairment value relatively fairly or not. How do you determine the impairment? It is whether recoverable amount is less than the carrying amount. So they now have to record it at the recoverable amount. How do you determine the recoverable amount? It is the higher of the value in use and the selling price less cost to sell. So you're going to have to go and get those details to determine the recoverable amount, to then compare it to the carrying amount, to then see if it needs to be impaired. they do have to do an annual assessment if there is an indication of impairment. So you're also going to have to go and physically look at the item to see if there is an indication for impairment, and therefore this assessment must be done. Okay, disclosure in terms of it, the notes are huge. So look here, this is what needs to be disclosed in terms of your PPE. So you've got to have your carrying amount at the beginning of the year, which is going to be the sum of your cost less your accumulated depreciation. So this would be old items. These are not transactions. This is your opening balance. But then additions and disposals, these are the transactions that they entered into during the year. They add their additions, they deduct the disposals. The depreciation, impairment, and revaluation, all of these are based on the subsequent measurement requirements to make sure that the PPE at year end is actually a fair amount. So you can see literally to get to that carrying amount at year end, it is a balancing figure of the opening plus your transactions less subsequent measurement requirements, and then you have your cost portion of that and the accumulated depreciation portion of that. Because remember, your additions will be depreciated from the date that they were available for use, and your disposals up to the date that they were sold will be depreciated. And in addition to that, your opening PPE will be depreciated for the whole year if it still remains an asset for the whole year, or if it gets disposed of up until the date of disposal. Okay, so that's depreciation, impairment, revaluation is to bring the closing value to the correct amount. That's what needs to be disclosed. So you won't have to go into the detail of disclosure again unless the question is solely focused as disclosure, but you will have to say you need to make sure it has been disclosed according to your IFRS requirements.